All right, stocks a little bit better than when we began the show here. Dan Genter joins us to continue the conversation, CEO and CIO at Genter Capital Management. Dan, good to have you back. Good afternoon.
Oliver, great to be back with you.
So we're sitting here in the middle of this whippy rotation. How have you kind of adapted? And we were talking with our previous guest there about, dropping off luxury stocks. He's a little worried about the economy. What do you think about these things? Should we be dialing back our exposure to U.S. consumers?
Well, I think that what you're dealing with is you've got a rotation, and clearly that's going on that's out of the tech side. And this year, everything has been tech and everything has been AI. And you basically have had the whole market is kind of a standard SUV that's been plodding up the mountain. And then you've had this monster truck in front with attached to a chain that's been pulling the rest of the market along with it. And, look, the hill just got a little too steep. It got a little too muddy. It's starting to slide back. And so people, that vehicle that's behind it's trying to get out of the way and doesn't want to get caught in the slide. So you're seeing rotation. Clearly, some of what's going on in the consumer area, what's going on in the healthcare area, the finance area. I mean, these are all areas that have been dramatically undervalued. They're at PEs that are at historical norms, frankly. I mean, matter of fact, you've got half of the S&P 500 is still below the levels they were in 2021. You've got about a third of the market that's down 20% of the S&P from where it was in 2021. So there's a number of other values that are out there, and people are seeing, look, this train, though it may have been a bullet train, is slowing down, and it's time for us to go into some other areas. Okay.
The other areas that have been working, we talked housing, we talked regional banks. Some of that seems pretty rate related. But there's also some life in biotech, healthcare. I know that's an area you're dabbling in, but you're going for one of the big losers for a turnaround, CVS. No. You're going to the lion's den. That thing's been a mess.
It's been terrible. And the fact of the matter is the entire pharma area has been under a double barrel pressure. It's been hit by the current administration that keeps beating up on it. And then anyone that's had any kind of Medicare affiliation has really been hit, just because of the renegotiations and the changes in the Medicare contracts. And look, they missed earnings last quarter. The stock got smacked. But when you look at it right now, it's trading at about an 8 PE, normally trades at roughly 14. You're getting 4.6% while you wait. They actually have a solid balance sheet. The cash flow is fine. And basically what they're going to have long-term out of Medicare is going to be a real driver. So we just think the stock is dramatically undervalued at roughly 58, and we think it's an $80 stock. And you're going to get paid 4.6%, almost 5% while you wait. And so we see it dramatically undervalued. And at least in the last two trading days, other people are starting to see some of that value also.
Okay. It seems like they still should have a pretty stable business, given that they've lost competition with so many closures of other pharmacies, and there's this whole trade related to aging and demographics too. That's like helping all healthcare in general. I mean, I feel like CVS shouldn't be breaking too far away from that. Like, it's where you go to fill your prescription still for like 95% of people.
Absolutely. I mean, you're going to much stronger pharma application than clinical application, just because the clinical applications to healthcare is so much more expensive. And CVS sees that. Obviously, they're at the forefront with regards to clinical application. And more, these major chains are also going to do small, non-critical, medical treatment where, look, if you need a few stitches, you just don't need to go sit in an emergency room for 6 hours. And so that's going to be the future. That's where they're going to go. Medicare is going to be a big part of that. And CVS right now, as I mentioned, I think you can just, we're picking it up and we're buying it now at what we feel is a real bargain. And look, if it takes a little time to mature, we're going to get 5% while we wait. So it's not a bad place to hang out.
Okay. On the other end of the spectrum, though, you're also buying SIGs, Altria, which has been on a huge run. So, all right, you got one healthcare and one not so much healthcare.
Yeah, we're going to try to play both sides.
Both staples, maybe.
Yeah, and look, Altria is just the wonderful thing about Altria is it's hard to go wrong with addiction stocks. And the reality is that Altria, basically the whole play is free cash flow. It's got tremendous free cash flow. It routinely increases its prices 5 or 6% a year. You're getting a 7.9%, literally an 8% dividend while you wait. So you're above bond levels while you wait, yet the dividend's getting taxed at 20%. So it has preferential tax treatment. It's not getting taxed as ordinary income. And yet it's still at a 9.7 PE. So, in this market in particular, at 49, it's another stock we just see is significantly undervalued and literally has $65 potential. And you're going to get, again, 8% while you wait.
All right. Yeah, pretty darn good yield. I mean, that seems like right now one of the ways to avoid some of the equity carnage is to at least collect some income. I mean, the stock's been on a big run. What do you think is possible here, Dan? Do you think about like levels at which you'd want to get out? I mean, it's ramping up big.
Well, we have a target of 65.
Okay.
And we think that still puts it at a reasonable multiple. You've got the very, very strong cash flow. And actually, they have another tailwind right now, which is really unusual for them, is that in the last year, they've actually had some positive regulatory trends. Instead of that normally being an anchor around their neck, some of that weight's actually dropping off. So it's going to allow them actually to accelerate some of their distribution. And that's a positive that they rarely get.
Okay. Before I let you go, another winning stock coming back to the banks. Close out the chat here. M&T, one of the ones you like in the mid-cap category. We still describe them as regional, or how do you think about it, Dan?
Well, look, it's a super regional, and the big play here is they are way ahead of their peer group with regards to commercial real estate. I mean, they're not that exposed. They've cleaned up a lot of what they have. They normally trade at about 1.08 a book value. Right now, they normally trade at about 132 the last 20 years. Now they're about 1.08. So again, they're just ahead of the game. I mean, where interest rates are, all these banks basically have been able to increase their net interest margins. So profitabilities and margins have improved. And then again, the shadow in the dark that's haunting them all is where are they with commercial real estate? And they're just a regional, and unlike a lot of regionals, they just didn't have as much exposure and have addressed it ahead of time. Again, you get a 3.1% dividend, and this year and next year, they're going to be buying back about 2.8% on a share buyback. So you're going to get the 3.1% dividend, then another 2.8 in share buyback. So you're literally getting about a 6% cash on cash return from those two elements.
Yeah, some pretty compelling math and some good creativity in the stock picks, Dan. Good stuff. Thanks.
Great.
Yeah,
good to be with you.
Yeah, good stock picks.